The entry is probably the most important part of your strategy. In this video, I will share with you how you can use the edge ratio to select the most profitable entries.
The edge ratio is calculated using each trade's maximum favorable excursion and maximum adverse excursion. Let's briefly discuss these concepts. Maximum favorable excursion is the largest open gain during a trade. It measures the furthest that prices moved in your favor. Maximum adverse excursion is the largest open loss during a trade. It measures the furthest that prices moved against you. Both MAE and MFE are calculated relative to your entry price. Suppose you have a trade that progresses as shown. The trade was closed at break-even, but had an MFE of $20 and an MAE of $30. When backtesting your strategy in StrategyQuant, you can track the MFE and MAE values for each trade. I prefer to display MFE and MAE in pips since this removes the effects of fluctuating currency values. StrategyQuant automatically calculates the edge ratio for you, but I'll use this hypothetical 5-trade backtest to demonstrate each step of the calculation. The edge ratio is equal to the MFE to MAE ratio normalized by the prevailing market volatility when the trade is opened. It essentially measures the entry's ability to accrue profits. This normalization is necessary because volatile markets tend to produce higher MFE and MAE values. The prevailing 14-period ATR at the trade open will be used for normalization. First, normalize volatility by dividing the MFE and MAE by the ATR. Next, obtain the average normalized MFE and MAE values. Finally, obtain the edge ratio by dividing the average MFE by the average MAE. An edge ratio of 1 indicates equal amounts of favorable and adverse price movement. The 2.63 ratio above indicates the strategy is far more likely to produce open profits. This correlates with the 125 pip gain after the 5 trades. You can use the ratio to evaluate complete strategies, or any strategy element of interest. Since MFE and MAE are often used to track trade progression without any exits, I think the edge ratio is best suited to evaluate entry profitability. That's what we'll do now. I'll compare the performance of 2 popular indicators, Bollinger Bands and Keltner channels. These indicators are visually similar. Each consists of a middle moving average surrounded by a pair of upper and lower bands. The Bollinger bandwidth is ±2 standard deviations, whereas the Keltner channels use ±2 ATR. Standard deviation accounts for directional volatility, unlike the ATR. This makes the Bollinger Bands expand more during market trends. Each indicator will be used to generate trend-following entries for the 30-minute pound-yen. Trading logic is as follows. I will buy when price closes above the upper Bollinger Band or Keltner channel, and sell when price closes below the lower Bollinger Band or Keltner channel. I will exit each position after 50 bars have elapsed. The 50-bar time stop, which equals about 1 day on M30, gives each signal equal time to generate profits. The strategies were quickly programmed in AlgoWizard. I'll optimize each indicator's look-back period from 10 to 100, in steps of 1. Plotting the edge ratio across a large range of look-back periods allows a more comprehensive assessment of entry profitability. The strategies were then loaded into StrategyQuant's optimizer and set up as shown. After backtesting from 2003 to 2021, here are the edge ratios as a function of the indicator look-back period. Even with these basic entry signals, it's reassuring that both indicators produce an average edge ratio exceeding 1. The Bollinger Bands start to consistently outperform the Keltner channels for look-back periods above 50. I would pick a period in the 80 to 100 range for further development. Periods above 100 are feasible as long as you don't mind the lower trading frequency. I suspect the Bollinger Bands' faster and larger expansion during market trends is the reason behind this performance improvement. Their widespread popularity is certainly justified. Unlike most performance metrics, the edge ratio takes both open profits and losses into account. This can help you determine optimal trade exits. For example, if your entry has mediocre closed trade metrics but a high edge ratio, it's likely that you're giving back a chunk of open profits. A profit target or a tighter stop loss would be handy in such cases. Secondly, since the edge ratio is volatility normalized using the ATR, you can use it to compare performance across different markets, or across different regimes for the same market. Unfortunately, since we use the average normalized MFE and MAE values, the edge ratio is not affected by trading frequency. Higher trading frequencies are usually preferred because they generate profits faster. To alleviate this, you can plot net profit versus look-back period instead. A simple reversal strategy, which is always in the market, will suffice for such cases. You can use both methods concurrently to get a more comprehensive overview of your entry performance. Lastly, the edge ratio calculation is sensitive to backtest precision. Ideally, your backtest should be precise enough to capture the changes in MFE or MAE within each bar. For example, if your backtest engine only evaluates performance at the open of each 30-minute bar, the price sequence within each bar cannot be precisely replicated. For best results, you should backtest with tick precision or at least with 1-minute OHLC prices. The edge ratio is a unique metric that considers the open profits and losses generated by your entries, possibly giving it an edge over more conventional metrics. Plotting the edge ratio against your indicator look-back period gives you a comprehensive assessment of each entry's profitability and helps you select an optimal look-back period. As long as you quantify your strategy's performance with a method you're confident in and understand the associated benefits and drawbacks, the odds will be in your favor. Happy trading, and thanks for subscribing.